The global energy market has just entered a new phase of strategic competition. The old rules are being rewritten. The new tools of influence are powerful tariff policies, trillion-dollar supply pacts that function like economic alliances, and strategic policy shifts that can reroute global energy flows overnight. These are not just market trends, they are calculated moves of economic statecraft. In this analysis, we connect the dots on 5 key developments from this week that reveal a new, emerging battlefield for energy and influence. First, a new energy partnership that redefines the transatlantic relationship for a generation. Second, a powerful demonstration of economic leverage that has sent a shockwave through the global oil trade. Third, a major policy recalibration that signals a shift in U.S. priorities. Fourth, a corporate strategy that prioritizes shareholder defense above all else. And finally, the rise of a new type of energy company that could become the blueprint for the future. We begin with the most significant energy deal of the decade. The United States and the European Union have finalized a $750 billion energy partnership. This is far more than a simple trade agreement. It is a long-term, structural realignment of the transatlantic energy supply chain, designed to permanently secure Europe's energy needs with American LNG, oil, and nuclear fuels. But the true power of this deal lies in its investment component. It includes a commitment for $600 billion in European Union investment into U.S. energy infrastructure. This is the lock-in mechanism. By co-funding the terminals, pipelines, and facilities on U.S. soil, Europe is ensuring its access to American supply for decades to come. It creates an interconnected economic bloc and solidifies the role of the U.S. as the primary energy supplier to the continent. While one partnership was solidified, a powerful new tool of economic policy was put on display. In a stunning development, Indian Chevron refiners have abruptly halted all new purchases of Russian crude oil. This wasn't driven by market prices or a change in demand. It was a direct response to a U.S. policy statement threatening to impose a 100% tariff on countries continuing to import Russian crude. This sets a powerful new precedent. It demonstrates that the threat of tariffs can be an incredibly effective tool of economic statecraft, succeeding in redirecting trade flows where other mechanisms have had limited impact. This signals a new phase in economic sanctions policy, one where the risk calculation for trading with certain entities has fundamentally changed for nations and corporations around the world. As the U.S. projects its economic influence abroad, it is also making major strategic recalibrations at home. This week, the U.S. government restored Chevron's license to operate and pump oil in Venezuela. This is a stunning reversal of a long-standing policy aimed at applying political pressure. This decision reveals a significant shift in U.S. priorities, with Chevron accounting for a substantial portion of Venezuela's output. This move is a pragmatic step to increase the global supply of oil in a tight market. It signals that ensuring immediate market stability and energy security is now a primary driver of energy policy, at times taking precedence over longer-term foreign policy objectives. While nations make geopolitical moves, major corporations are navigating their own complex challenges. This week, Shell reported a 32% drop in profits compared to last year. And yet, the company still beat analysts' forecasts and immediately announced another massive $3.5 billion share buyback. This highlights the dominant corporate strategy in today's market: capital discipline. For Shell, even with rising debt and a softer market, the #1 priority is returning cash to shareholders. In a volatile, lower-margin environment, this focus on buybacks is a defensive strategy. It's designed to maintain investor confidence and support the company's stock price, signaling that shareholder value will be protected above all else. In stark contrast to that defensive posture, Brazil's national oil company, Petrobras, is on the offensive. This quarter, Petrobras shattered its all-time production record, driven by a new fleet of highly efficient production platforms in Brazil's incredibly rich pre-salt oil fields. This surge has turned the company into a global production powerhouse, But this isn't just a story about volume. Petrobras is executing a unique, dual-track strategy. It is aggressively growing its low-cost oil production, while simultaneously investing heavily in the energy transition, launching venture capital funds for decarbonization, and piloting new low-carbon marine fuels. This approach dominating current production while preparing for a post-carbon world is creating a formidable new blueprint for the 21st century. National Oil Company, one that is built to thrive both now and in the decades to come. So, what do these 5 events tell us? A new transatlantic energy bloc, a powerful new tool of economic leverage, a pragmatic pivot in U.S. foreign policy, a defensive corporate strategy focused on shareholder returns, and the rise of a new, future-proofed oil giant. Together, they paint a clear picture of a global energy market in a state of profound recalibration. The rules are changing, economic power, strategic alliances, and national interests are now the primary forces shaping the flow of energy around the world. Understanding these new dynamics is no longer optional, it's essential for navigating the complex landscape that lies ahead.